Good morning. As of the closing bell yesterday, November 4th, 2025, the U.S. markets are now closed. And for supermicrocomputer ticker SMCI, it was a day of reckoning. The stock finished the main trading session at $47.51, a brutal drop of 6.38%. But the story did not end there. In the after-hours session, the real damage became clear as the stock continued to plummet, falling another 9.28% to land at just $43 flat. This is a complete and total rejection by the market of the earnings report that was just released. The common belief, the expectation, was that SMCI is the single best way to play the artificial intelligence build-out, a direct partner to NVIDIA that could do no wrong. The reality, delivered in yesterday's financial report, is that the company just posted a massive quarterly revenue miss and a stunning 15% year-over-year decline. The market is now faced with a story that simply doesn't add up, and investors are voting with their sell buttons on their Fidelity mobile app and Robinhood accounts. What we are seeing is a classic and painful dislocation between a company's narrative and its actual performance. The immediate insight here, looking at that $43 after-hours print, is that the market believes management's excuses for the quarter are not credible, even if their future promises are massive. This is the ultimate expectation versus reality scenario. The expectation was that SMCI, as the premier builder of high-density AI servers, would be swimming in orders, unable to keep up with demand. The narrative was that as NVIDIA stock soared, SMCI will be right there with it, providing the essential picks and shovels for the gold rush. This narrative has been the driving force for a long time, leading many to seek investment help on how to get exposure to this theme using online investing platforms to build a position. And then reality hit. Yesterday's first quarter fiscal year 2026 earnings report was a bombshell. Revenue came in at $5.02 billion. The consensus estimate, what Wall Street was expecting, was over $6 billion. This wasn't a small miss, it was a canyon. It represents a 15% decline from the same period last year. Think about that. In the middle of what we are told is the biggest technology build-out in a generation, this company's sales fell. Net income was more than cut in half. This is the kind of data that makes you stop and question the entire story. Now, management was quick to offer a reason. They said the miss was due to design win upgrades. In plain English, they claim their biggest customers delayed their orders, pushing them from the first quarter into the second because they wanted to wait for the next best thing, namely systems built around NVIDIA's new Blackwell architecture. Here is the central conflict. In the very same breath that management reported this disastrous quarter, they raised their full-year guidance. They didn't just nudge it up, they guided to at least $36 billion for the fiscal year, up from a previous $33 billion. They cited a rapidly expanding order book, including more than $13 billion in orders just for Blackwell Ultra systems. This is where the tension becomes unbearable. The expectation is now split. Management is telling you to ignore the burning house in front of you, the Q1 miss, and instead look at the beautiful unbuilt mansion they are promising to build next year, the 36B guidance. The market, in its brutal efficiency, looked at this situation and said no. The stock's collapse, especially the after-hours drop, isn't about the revenue miss. It's about something much more dangerous: margins. The real story, the one that smart institutions and anyone managing an intelligent portfolio is looking at, is the gross margin. It came in at 9.3%. A year ago, it was 13.1%. This is a collapse. This single number undercuts the entire bull thesis for the company. It suggests that SMCI is not a high-tech, high-value partner. It suggests that the server market is becoming commoditized. It suggests that competition is here, and it is fierce.